Welcome back to AusBiz Live. Well, we all know bear market bottoms can be breeding grounds for bull markets, so it's time to start putting money to work. There may be some great opportunities out there. Let's bring in Bogdan, get his view from Blackmore Capital. Marcus, pleasure to have you on the show today. I guess just start with talking us through this. I mean, in terms of what we're seeing with what you might call what we would call a bear market, can you talk us through some of the stages you're watching at the moment and where we're at in markets, the phases we're in?
Sure, Ingrid. I think we're still very much in stage one, and I think it's really important to frame your portfolios and the risk analysis around these different stages and how you play that through this particular cycle. We entered the cycle where valuations were very, very high, momentum was strong, and value was very, very weak. At this stage, it is all about, from our perspective, is about earnings quality, earnings resilience, and strong balance sheets, both from solvency and liquidity issues. And so, in the first instance, it is really looking at those companies that have very, very solid earnings profiles. That would be areas in consumer staples, such as Coles and Woolworths. Packaging groups like Amcor and logistics companies like Brambles, and to a lesser extent waste industry, things like Cleanaway Waste Management. Healthcare, there's certain names in healthcare which I think are more resilient. ResMed is one, CSL is another. And finally, telecommunications. We're all working from home. The use of data is surging, and I think there's resilience around those types of companies. We think that the recent rally is a bear market rally. We're still very, very cautious. Earnings have not been downgraded sufficiently, and so for the moment we are definitely playing in those sort of consumer staples and safe balance sheet areas at this stage.
So Marcus, those are sort of some of the areas of the market that you anticipate will see strength through this period of uncertainty. Do you start to see value, though, emerging in any names? And I'm thinking of potentially even some A-REITs.
Yes, I think that's the next stage, and that's stage two, where we're looking at high quality, large cap liquid stocks. And in the REITs section, we would be looking at things like Goodman Group or possibly Mirvac. But it would be also more companies around like BHP and Rio, and understanding that China was the first into this crisis and they're going to be certainly the first out of this crisis. And what are the companies that could benefit from an increase in activity in China? And so far we would say BHP and Rio at this point in time.
So do you think they've been oversold at the moment?
I think this is the great chance of where you're getting quality companies at a reasonable price. We still think it's going to be. We're still very cautious. We think there's going to be lots of ups and downs, and we're probably still skewed on the downside. But this is the time to gradually look at those high quality names and to find value in those sorts of names.
Yeah, so still at stage one. We've had, you have to say, pretty modest expectations of between 1% and 2% earnings growth for Australian companies. I believe that's what you had it pegged at, regardless there at Blackmore Capital. I mean, do you think that even that type of growth is looking optimistic in some cases at this
Certainly.
time?
Oh, absolutely. I mean, that was consensus earnings of 1% to 2% growth on sort of around February 20th. Mm-hmm. We've had a complete change in the environment now, and so we're modelling around declines of around 20% earnings per share declines, and also quite significant declines in dividends. And we see it as a sort of a 3-year turnaround to get back to sort of 2019 levels in terms of earnings and dividends. So we're still very much at the early stages there. So our base case at the moment is sort of minus 20 for this financial year. And so the focus on those high quality names in that type of environment is still absolutely of paramount importance.
Boy, 20%. I mean, you have to feel for people who are sort of on the cusp of retirement looking at those types of falls. I'm curious to get your thoughts on the banks. How are you viewing the likes of NAB now? Does it make a difference if it's, the big four? Does it make a difference if it's the Macquarie groups of the world? What are you looking about the financials?
Sure. I mean, I think one of the great lessons that we learned from the global financial crisis is that we needed to have the capital positions of Australian banks incredibly strong, and there's been a lot of work that's been done over the last decade there. We are still cautious around the banking sector in general. We would lead with Commonwealth Bank and then second NAB. I think you need to watch very, very closely the unemployment levels and the pressure there potentially that can have on mortgages. But I think the capital position is very, very strong in banks. I think where there is risk is certainly dividend cuts going forward. And so we would look at that as a sort of second derivative risk that you could see in banks. Macquarie Bank, we would classify as a very high quality Australian beta company. And that would be in our stage 2 of companies that we would look at. Best of breed, have gone through financial crises before and have been very, very nimble in their business model. And our preference would probably be leading with something like Macquarie Bank over the retail banks at this point in time.
Right, Marcus, Bogdan, thank you so much for joining us from Blackmore Capital in Melbourne. Good to see you there today.
It's a pleasure. Thank you.